Picture your restaurant during the dinner rush. The clatter of plates, the sizzle of the grill, your team moving in perfect rhythm. Now imagine that right under your nose, thousands of dollars are quietly slipping out the back door. Not through theft, not through waste, but through something far more insidious: missed tax deductions and credits. Every year, restaurant owners just like you leave a small fortune on the table, simply because they're focused on what matters most: running their business. We're going to change that today. We'll unpack 7 commonly overlooked tax opportunities, explain why 2025 is a pivotal and urgent year, and give you a practical, restaurant-specific playbook to convert routine costs into real cash flow. By the end, you'll know exactly where to look and what to do. Ready to stop leaving money on the table? Great. Let's pull back the curtain. So why should you care right now? Let's look at the real numbers. A typical restaurant with $300,000 in annual tips could be missing nearly $23,000 in FICA tip credits alone. And that's just one of 7 opportunities. Add in undocumented food waste, same-year equipment write-offs, employee meal deductions, uniforms, delivery miles, and enhanced interest deductions, and we're talking about potentially $50,000 or more in missed deductions and credits every single year. In a business where margins are made at the edges, that kind of money is the difference between scraping by and funding a serious expansion. And here's what makes this even more urgent. The clock is ticking. Thanks to recent tax law changes, some of these deductions disappear forever, starting January 1st, 2026. That makes 2025 your last golden opportunity to claim them. The question is, are you leaving yours behind? Let's look at why so many operators are. So why aren't restaurant owners claiming money they've rightfully earned? The answer is surprisingly simple. Most accountants don't speak restaurant. Your generalist accountant might see a $50,000 commercial oven and automatically spread that deduction over 7 years using standard depreciation. But a restaurant-savvy specialist knows you can write off that entire oven in year 1 using Section 179 and bonus depreciation. That's a $15,000 difference in immediate cash savings that simply vanished with the wrong advice. Generalists also miss the nuances in tip reporting, food spoilage thresholds, employee meal classification, and specialized credits. They don't know that the IRS watches spoilage above roughly 8%, or exactly how to document a food donation to make it bulletproof. They don't live and breathe the unique cash flow patterns and seasonal challenges that define this industry. This disconnect between general advice and restaurant-specific knowledge is where profit goes to die. So how do we bridge the gap? With a focused, restaurant-first playbook. Instead of randomly chasing deductions, here is a 7-pillar framework built specifically for restaurants. Think of it like a blueprint for the perfect recipe. Each ingredient has its place, its timing, and its specific measurement. Pillar 1 focuses on employee meals. Separate them into 2 buckets: convenience of employer meals at 50% deductible and de minimis meals at 100% deductible. Both valid through 2025 and both becoming non-deductible in 2026, so plan now. Pillar 2 tackles equipment using Section 179, up to $2.5 million with phase-out above $4 million, and layers in 100% bonus depreciation for qualifying assets purchased after January 19, 2025. Pillar 3 builds a bulletproof documentation system for waste, logging dates, items, quantities, reasons, and cost, plus properly receipted charitable donations with fair market value. Pillar 4 codes required uniforms and non-slip shoes as fully deductible. Pillar 5 captures delivery miles at 67 cents per mile for 2025, or actual costs, whichever is greater. Pillar 6 claims the FICA tip credit at 7.65% of qualifying tips, a direct dollar-for-dollar reduction in your tax bill. And Pillar 7 recomputes your business interest deduction limit using OBBA's restored add-backs to unlock more of that expense. This isn't a checklist, it's an operational system. Let's look at what these pillars are actually worth. Let's quantify exactly what we discovered when we mapped these 7 opportunities. First, employee meals. $10,000 in convenience meals gives you a $5,000 deduction, and $5,000 in de minimis meals gives you another $5,000. That's $10,000 in total deductions that vanish completely in 2026. Second, equipment. Instead of depreciating a $50,000 oven over 7 years, Section 179 and bonus depreciation let you deduct it all in year one. At a 30% combined tax rate, that's $15,000 in immediate cash back. Third, waste and donations. Document 5% waste on $200,000 in food costs for a $10,000 deduction, plus another $5,000 for properly receipted charitable food donations. Fourth, uniforms. $3,000 in required attire is fully deductible. Fifth, vehicle. 20,000 business miles at 67 cents equals a $13,400 deduction. Sixth, and this is the crown jewel, report $300,000 in tips and claim the FICA tip credit at 7.65%. That's roughly $22,950 coming straight off your tax bill, dollar for dollar. Seventh, enhanced interest deductions under OBBA's add-backs could recover approximately $10,000 on a $100,000 loan. Stack it all together, and you are looking at a transformational boost to after-tax cash flow. Now, let's turn these findings into moves you can make this week. Now, let's make this real and immediate. Right now, today, separate your employee meals into the correct buckets so you stop leaving that 2025 deduction on the table. Enable a mileage tracking app for any vehicle used in deliveries or business errands. Start a clean daily spoilage log with columns for date, item, quantity, reason, and cost. And create a folder, physical or digital, for donation receipts and fair market value documentation. This quarter, review your equipment pipeline and align purchasing timing with Section 179 and 100% bonus depreciation for assets acquired after January 19, 2025. Formalize your uniform policy and make sure required attire is coded as fully deductible. Pull your POS tip data and compute the FICA tip credit you should have been claiming. This year, recalculate your business interest deduction limit under OBBBA, tighten your documentation standards across the board, and build a monthly restaurant-specific financial close into your operating rhythm. These are not complicated systems. They are small, consistent habits that stack into serious, repeatable cash flow wins, and the calendar adds urgency to every one of them. Here is the paradigm shift that separates restaurants that thrive from those that struggle. Through 2025, properly categorized employee meals, both convenience of employer and de minimis, still generate real deductions. Starting January 1st, 2026, both categories become completely non-deductible. That window closes permanently, and no amount of scrambling will reopen it. Meanwhile, the FICA tip credit has been permanently expanded. This is now a lasting feature of the tax landscape that will continue delivering thousands of dollars annually for as long as you run your restaurant. Section 179 and 100% bonus depreciation for qualifying assets purchased after January 19, 2025 remain powerful tools for front-loading equipment costs. OBBBA's restored add-backs allow more of your business interest to be deducted right now. The new default is this: stop treating taxes as a once-a-year headache managed by a generalist and start treating them as a profit center powered by specialized systems and restaurant-specific expertise. Proactive monthly tax strategy integrated into your daily operations. That is your new competitive advantage, and it starts with the right partner by your side. Here is where we land. 7 opportunities, 1 continuous plan. Claim 2025 employee meal deductions while you still can. They are gone in 2026. Time equipment purchases to maximize Section 179 and 100% bonus depreciation for qualifying assets. Turn spoilage into documented deductions and food donations into supported write-offs. Code required uniforms at 100%. Track delivery miles or calculate actual costs. Choose whichever delivers the better outcome. Capture the FICA tip credit at 7.65% of qualifying tips, dollar for dollar, every single year, and deduct more interest under OBBA's restored add-backs. The research is clear. Restaurants that adopt specialized tax strategy don't just save money, they build empires. The old reactive model of tax preparation is finished. The new reality demands proactive, monthly strategy integrated into your daily operations. Your action item today is simple. Pick one of these 7 areas and implement it by the end of this week. Then stack the rest. Start building the thriving restaurant you deserve, because every day you wait is another day you are leaving money on the table. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.